We are repeatedly told that the modern path to wealth is simple. Buy an all-world index fund, ignore the noise, and wait. But when you examine how turbulent the markets actually are, you have to ask if putting every dollar you own into a system designed to fluctuate is the smartest play for your entire life savings. Exchange-traded funds, or ETFs, serve as the primary growth engine for modern investment portfolios. At their core, they are pooled baskets of assets, like stocks or bonds, that trade in real time on public exchanges, exactly like a single company stock. The appeal is obvious. You get immediate, incredibly low-cost exposure to the entire global market. But that frictionless access exacts a toll. You bear 100% of the market's downside risk, and you carry the behavioral temptation of being able to liquidate your portfolio from a smartphone. Frictionless access is a double-edged sword. When the market drops, the ease of selling can quickly turn a temporary dip into a permanent destruction of your capital. This introduces a different class of financial tool, segregated funds. Think of them as a wealth wrapper used to fortify your capital. On the inside, they function similarly to mutual funds, holding a diversified portfolio of assets. But on the outside, they are masked entirely within a legally binding life insurance contract. This graph shows an investment dipping, but notice the thick floor beneath it. The insurer guarantees your principal is protected, but this requires concessions. You accept a 10-year lock-in period and pay higher fees to fund the insurance. You are paying a premium to transfer the risk of a market crash from your shoulders to the insurance company. This shifts your posture from aggressive speculation to rigid capital preservation. This matrix charts your options. On the x-axis, we have your time horizon, and on the y-axis, your actual risk and liability. We map the tools to the timeline. First is the accumulator. If you have decades before retirement, a strict budget, and the discipline to ignore market drops, your priority is compounding growth. You are the perfect match for ETFs. Accumulators should deploy these ETFs in tax-free savings accounts or non-registered accounts. Because ETFs swap assets directly with authorized participants, they are incredibly tax efficient. Only about 6% of ETFs pay annual capital gains. On the opposite end is the protector. Pre-retirees, estate planners, and business owners require the defensive structure of segregated funds to ensure the wealth they've already built survives. Protectors deploy seg funds inside RRSPs, RIFs, or corporate accounts. Here, shielding the principal and generating predictable income takes priority over chasing absolute yield. Matching the asset wrapper to your specific life stage and account type prevents you from exposing critical capital to the wrong kind of risk. We also need to look at the hidden costs of ETFs. The zero-commission, gamified environment of modern brokerages creates a behavioral trap. Constant, easy access to a portfolio induces retail investors to react emotionally. You are far more likely to panic sell during a dip or overtrade to chase a rally when you can transact in seconds. This graph compares theoretical gains against actual results. The smooth upper line is the ETF's performance, but the volatile lower line tracks actual retail returns. Retail accounts trade 35% more frequently than traditional funds, and that slippage wipes out an average of 1.30% in yearly returns. Beyond behavior, there is execution danger. Buying into niche, thinly traded thematic ETFs exposes your portfolio to severe market friction. During volatility, the gap between what buyers pay and sellers accept widens. These bid-ask spreads act as hidden tolls, sometimes spiking up to 1.50%, instantly negating the low expense ratios ETFs advertise. Then there is fund closure risk. Roughly 10% of trendy ETFs shut down within their first 3 years, forcing sudden liquidations and generating surprise tax liabilities for the investor. The reputation of index funds as flawless and cheap ignores the systemic friction and behavioral taxes that consistently erode retail wealth. Segregated funds utilize legal protections and insurance guarantees that justify their higher management fees. The first is a mechanical reset feature, utilized during prolonged bull markets. This chart shows how the reset operates. As your investment grows, you can reset your contract. This legally locks in paper profits, clicking that guaranteed floor upward to protect your new baseline against future crashes. Next is the estate planning advantage. The insurance contract allows you to name a direct beneficiary. Because the asset passes directly to the beneficiary, it bypasses the public probate process entirely. This expedites private wealth transfer, while legally avoiding estate taxes and executor fees. For business owners, there is statutory creditor protection. If the business faces bankruptcy or a professional civil lawsuit, personal life savings held within a segregated fund are shielded from the claims. These legal and structural features allow you to treat your capital as a fortified wealth moat. The truth is, you do not have to choose between extreme growth and extreme protection for your life savings. This is the barbell strategy. You divide your central capital pool into two distinct buckets. On the left, allocate your high-risk, long-term accumulation capital exclusively into ETFs. On the right, allocate your critical liability and legacy capital into segregated funds. By bifurcating your capital, you capture cheap upside while entirely eliminating the stress of a single point of failure in your portfolio. Executing this dual strategy requires selecting the correct issuers. For the ETF side, look to heavyweights like BlackRock's iShares, Vanguard, and BMO. Their deep liquidity and tight tracking error keep costs strictly minimized. For the segregated fund side, choose bulletproof insurers like Canada Life, Sun Life, and Manulife. They offer the robust guarantees required to secure your assets. Protection is not a waste of money, and index funds are not inherently flawless. Optimize your portfolio based on reality. Match the financial tool directly to the specific liability it is designed to manage. Mastering this critical trade-off ensures your capital remains firmly anchored, regardless of what the unpredictable market does next.